The speculative motives. It is demand for money as a store of wealth. Wealth can be stored in the form of property, bonds, shares, money, and gold, etc. For sake of simplicity, let's club all other forms of assets except money in one category called bonds. Thus, according to Keynes, there are two types of assets, that is, money and bonds. How to make best use of both? Considering if we deposit cash in saving bank account, we earn interest, and if we purchase bonds, we get monetary return on it. People compare rate of interest on bond with rate of interest on bank deposits. It is speculation about future changes, that is, rise or fall in interest rate and bond prices, which impacts speculative demand for money. To understand it better, let's first understand relationship between bond price and interest rate. Price of a bond is inversely related to the interest rate. How? Suppose $100 bond yields fixed return of 10% per annum, which means the bond has fixed annual income of $10. Let's assume that rate of interest in saving bank account falls from 10% to 8%. The question is, how much money kept in the bank will fetch interest of $10 at 8% interest rate? That is 0.08 multiplied with x is equal to $10. Hence, x is equal to 10 divided by 0.08, which results in $125. Clearly, $125 kept in saving bank account will give the same return, that is $10, as $100 invested in bond market. Naturally, people will prefer to buy bond than to deposit cash in the bank. Competition among buyers will result in increase in demand of bond and will push up the price of $100 bond to $125. Hence, conclusion is obvious: with fall in the market value of interest, that is, bank deposit interest, price of bond rises and vice versa. In other words, price of bond is inversely related to interest rate. Always remember, speculation about changes, that is, rise or fall in interest rate and bond prices, give rise to speculative demand for money. So, speculative demand for money is inversely related to interest rate. That is, higher the interest rate, smaller will be speculative demand for money. If market rate of interest is very high and everyone expects it to fall in future, that is, rise in price of bond, thereby anticipating capital gain from bond holding, people will convert their money into bonds. Thus, speculative demand for money is low. In figure, at very high rate of interest, people convert their entire money holding into bonds, indicating speculative demand for money is zero. On the contrary, if the interest rate is low and people expect it to rise in future, that is, fall in price of bond, anticipating capital loss from bond holding, people convert their bonds into money in order to avoid future capital loss. They hold up money balance thinking that income from non-monetary assets like bond will be low, and so the cost of money holding will also be low. Sometimes speculative demand for money becomes very high, so much so that when rate of interest declines to minimum, say 3% as shown, speculative demand for money becomes infinite. This pushes the economy into a liquidity trap and the speculative demand curve becomes flat.